Let's look at Cheesecake Factory. What is the market cap for Cheesecake Factory?
$1.7 billion. No PE because they've lost money in the last 12 months.
Okay.
And no profit margin. They've lost money in the last 12 months. So X there.
That was coming, right?
Yep. 2.1 billion. So the thing is, we got to kind of basically, they got rid of their dividend. They used to pay a dividend. Now they got rid of it.
It's an interesting point. When did they used to pay it, Paul? When do you see
year.
there? Oh, okay. So that's not safe. I didn't, most people are.
Revenue, last 5 years, 2.1 to 2.4. When it comes to chains like this, guys, you want to figure out how much of this growth is because of the company's existing stores. So you want to look at existing stores' sales growth year over year over year, as opposed to new stores. I don't know how many stores Cheesecake Factory is opening, how many they have. Actually, on the main page, it'll probably say how many they have. Does not say how many they have. Too bad, right? Ah, well. So anyhow, profit. So this is before the pandemic, guys. 116 to 128, check mark there. Okay, and then shares outstanding, 48.8 million down to 44 million, check mark there.
Check mark there as well. The shares going down. Let's go to current assets greater than current liabilities.
Current assets, 411 million. Current liabilities, 540, which seems to be pretty spot on for restaurants. They tend to have less cash on hand than liabilities.
So that's an X for X for Cheesecake Factory. How about free cash flow growth for Cheesecake Factory?
Again, this is before the pandemic. Let's look at it. So we had, what is this? 92 to 1, why is my math going bad? 135, 138, 140, 143. So check mark there.
Mm-hmm.
And then we had 200, we had 116, and we had 185.
The average free cash flow over the past 5 years is 147, Paul.
Okay. What was the market cap?
1.7 bill.
All right. Doesn't seem terrible.
No?
No. It's what is that, 12 times is 170. So it's about 12 times free cash flow. That's what we should do. Maybe instead of multiplying by a certain number, we should just see what the ratio is and see what the number is. Maybe this isn't so bad. The thing is, guys, you have to sit there and say, I always get worried about Cheesecake Factory because that's 30-foot high ceilings and no seats above. Now, I will say, have you been to a Cheesecake Factory lately? It's always a long wait.
I haven't noticed that.
Oh, I've always thought it was a long wait, unless you go to like a really obscure time.
It's a nice place to eat. I mean,
I enjoy the
inside,
food.
Yeah,
big glasses for my Diet Coke.
Their desserts are great.
Of course. 10 years ago, $340 million in long-term debt. 1.75 now. That's 5.5 times more debt. Now let's go see their revenue. Did their revenue keep up with that? So if their revenue was up 5.5 times, I'd say, okay, maybe that's not terrible. Let's go see. Their revenue over the last 10 years is only up 65%. So their revenue is up 65%, and their debt is up 400%.
Paul, what's the difference between revenue and operating revenue? Social distances, our gal from Toronto is asking.
They basically, so operating revenue is, so the extra, basically the same thing. Sometimes there'll be another revenue stream that's coming in, not from the operating business, and that would be a separate revenue item. You follow what I'm saying? So I'm trying to think of an example. I don't even know an example. Let's say it's, I really don't know. But the bottom line is, I always look at the top line. I just look at I should be looking at the total revenue number because I really don't care as long as they're bringing revenue in. But operating revenue is operating that business specifically. So again, their debt is up 400%. Their debt is up 400%, and the revenue is only up 65%. That's kind of a red flag for me. So remember, even though these 8 pillars are good, we still want to see where the revenue and debt comes into play. It's not something we've talked about a lot, but it's something we definitely need to consider.